In 2019, a pattern appeared in the bond market that most people completely ignored, not because it was obscure, not because you needed a finance degree to find it. It was published in real time on every major financial terminal on the planet. Economists were writing about it. The Federal Reserve was being asked about it at press conferences. It was, by any reasonable measure, hiding in plain sight. People ignored it because the last time this pattern showed up with any real force was 2006. And in 2006, the people who understood what it meant had to wait 3 full years before the rest of the world caught up with them. 3 years of being early. 3 years of looking wrong. 3 years of watching asset prices climb while their thesis sat in a corner, quietly waiting. And then 2008 arrived, and suddenly those people weren't early anymore. They were rich. The pattern is called a yield curve inversion. It is not new, it is not exotic. It has been the most reliable leading indicator of economic recessions in modern financial history, with a track record that would embarrass most professional forecasters. And right now, after one of the longest and deepest inversions ever recorded, the curve is doing something it has done only a handful of times in the last century. It is uninverting. And if the last 50 years of financial history mean anything at all, the next 18 months are going to be very uncomfortable for the majority of people, quietly catastrophic for the unprepared, and extraordinarily profitable for a small number of individuals who understood the mechanism before the headlines caught up. The question worth asking is not whether this matters. The question is whether you are going to be the person who reads about what happened, or the person who understood what was coming. Let's establish something before we go any further. This is not a story about abstract economic theory. This is not a lecture on monetary policy, and it is definitely not a prediction about what the stock market is going to do next Tuesday. This is a story about how financial systems accumulate invisible pressure, how that pressure builds slowly, quietly, in places most people never look, and how, periodically, something shifts, a signal flickers, a pattern that has appeared before every major economic dislocation in modern history begins to repeat itself. And right now, in the first half of this decade, we are sitting inside one of those moments. The yield curve inverted in 2022. It stayed inverted for over 2 years, which is among the longest sustained inversions ever recorded. Economists argued about what it meant. Some said a recession was inevitable. Some said the economy was too strong, too resilient, too fundamentally different for the old signal to apply anymore. The soft landing crowd grew louder. Consumer confidence ticked up. Stock markets made new highs. People started using the phrase, "this time is different," again, which is, historically, one of the most expensive phrases in the English language. Then, quietly, the inversion began to reverse, and that is where things get genuinely important, because the conventional read on this is that a normalizing yield curve is good news. The danger has passed. The Fed managed it. Crisis averted. But that is not what history shows, not even close. What history shows is that the inversion is the warning. The uninversion is often the starting gun. To understand why any of this matters, you need to understand what the yield curve actually represents. And to do that, forget everything you think you know about interest rates for a moment. Start with something simple. Imagine you are lending money to someone, a friend, a neighbor, a business. If you are lending them money for 1 week, you would probably charge a modest amount of interest. The time frame is short. The risk is relatively contained. You will have your money back before most things can go wrong. But if you are lending that same person money for 10 years, the calculation changes entirely. Over a decade, almost anything can happen. They could lose their job. The economy could deteriorate. Your own circumstances could change, and you might need the money back before they are ready to return it. You are being asked to tolerate a decade of uncertainty, and you expect to be compensated for that cost. So you charge more interest for the longer loan. Not because you are greedy, because uncertainty over time is a real cost, and interest is how that cost gets priced. This is the normal shape of things. Short-term debt costs less. Long-term debt costs more. Plot those interest rates on a graph, short maturities on the left, long maturities on the right, and the line slopes upward. That upward slope is a healthy yield curve. It reflects a world functioning as expected. A yield curve inversion happens when that logic flips, when short-term loans suddenly cost more than long-term ones, when the 2-year U.S. Treasury yield climbs above the 10-year yield, when investors, collectively and across trillions of dollars in transactions, are demanding higher compensation for lending money to the U.S. government for 2 years than for lending it for 10. That sounds like a technical anomaly, a data quirk, a footnote in a Bloomberg terminal.
But what it actually represents is something far more significant. It is the largest, most liquid, most sophisticated financial market on the planet sending a message. And the message is this: the near future looks more dangerous than the distant future. Something is wrong, right now, today, and we are not willing to take that risk cheaply. That message has preceded every major U.S. recession since 1955, without exception. Here is where the story gets genuinely interesting, because the yield curve does not just predict recessions. In a very real, very mechanical way, it helps manufacture them. Banks are the transmission point for this. The entire banking business model, in its most simplified form, is a bet on the yield curve. Banks borrow money at short-term rates. They pay you interest on your checking account, your savings account, your certificate of deposit. Then they take that money and lend it out at long-term rates. Mortgages, business loans, car financing, credit cards. The spread between what they pay and what they earn is their margin, their reason for existing, their entire economic justification. When the yield curve is healthy, that spread is positive. Banks profit, they lend more, businesses expand, consumers spend, the economy grows. When the yield curve inverts, that spread collapses or turns negative entirely. Banks are suddenly in a position where the economics of lending no longer make sense, so they tighten. They raise credit standards, they approve fewer loans, they pull back from risk. And this is where the quiet seizing begins. Not dramatically, not in a way that makes headlines, just a small business owner who applied for a line of credit and got denied. A developer who wanted to build 100 units of housing and couldn't get the financing to break ground. A company that wanted to hire 50 people but couldn't access the capital to fund the expansion. One by one, quietly, invisibly, the engine starts losing power. And here is the cruel irony embedded in all of this. The Federal Reserve is typically the entity most responsible for creating the inversion in the first place. When inflation rises, the Fed raises short-term interest rates to slow down the economy. This is their core tool. Raise rates, cool spending, reduce inflation. Textbook policy. But raising short-term rates while long-term rates stay anchored is precisely the mechanism that inverts the curve. The Fed does it deliberately, or at least they accept it as a necessary side effect of fighting inflation. And then the lag happens. The average time between a yield curve inversion and the beginning of a recession is 12 to 18 months. The damage is not immediate. It accumulates. It moves through the plumbing of the financial system slowly, like a slow leak in a pipe inside a wall. You don't know it's there until the ceiling falls. So the Fed raises rates. Inflation cools. They declare victory. The headlines get better. Consumer confidence improves. Markets rally on the narrative that the crisis was avoided. And then the recession they triggered 18 months ago finally arrives at the door. That is the mechanism. That is why the signal works. And understanding this is the difference between being surprised by what comes next and being prepared for it. Let's put some actual numbers to this because abstractions are comfortable and numbers are not. The 2022 yield curve inversion reached a peak spread of negative 108 basis points. That means 2-year treasuries were yielding over 1 full percentage point more than 10-year treasuries at their widest divergence. That is the deepest inversion since the early 1980s when the Federal Reserve, under Paul Volcker, was deliberately crushing inflation by driving short-term rates to extraordinary levels. The inversion before the 2008 financial crisis reached a depth of around negative 50 basis points. The one before the dot-com crash in 2000 was shallower still. The one before the 1990 recession barely registered by comparison. If depth and duration correlate with the severity of the economic disruption that follows, and the historical pattern suggests they do, then what we are currently looking at is not a minor blip. It is one of the most significant inversions in modern financial history. And then there is the uninversion timing, which is the data point almost nobody discusses because it is genuinely unsettling. In June of 2007, the yield curve normalized. Short-term rates fell back below long-term rates. The inversion ended. If you had looked at that single data point in isolation, you might have concluded that the danger had passed, that the warning signal had resolved, that everything was returning to normal. The recession officially began in December 2007. Bear Stearns collapsed in March 2008. Lehman Brothers failed in September 2008. The stock market lost over 50% of its value. In January of 2000, the curve normalized. The Nasdaq peaked in March. The crash extended for nearly 3 years. Trillions in market value evaporated. In 1989, the curve normalized. The recession began in 1990. The savings and loan crisis, which had been building quietly in the background, accelerated. The pattern is not ambiguous. The uninversion does not mark the end of the danger. It frequently marks the beginning of the most visible phase of it.
Now we get to the part of the story that the financial media tends to either sensationalize or completely ignore, depending on the day: the wealth transfer. When financial systems correct after extended periods of distortion, wealth does not simply disappear. Most of it transfers. It moves from the leveraged to the liquid, from the complacent to the prepared, from the people who were fully invested at the top to the people who had the patience and the positioning to buy when everyone else was forced to sell. In 2008 and 2009, U.S. equity markets lost approximately 55% of their value from peak to trough. Residential housing prices fell 30% nationally and over 50% in markets like Las Vegas and Phoenix and parts of Florida. Commercial real estate seized up. Credit markets froze. And simultaneously, a small number of individuals and institutions were buying. Michael Burry, a physician turned fund manager operating out of a small office in Cupertino, had been reading the same signal the market was broadcasting since 2005. He spent 2 years being mocked, facing investor redemptions, and watching his fund lose money on paper before his thesis resolved. His investors, the ones who didn't flee, made $750 million. John Paulson's fund made approximately $15 billion in 2007 alone by positioning against mortgage-backed securities. $15 billion in a single year. These are the extreme examples, the ones that get made into movies and discussed in business school case studies. But the mechanism that made them wealthy was not exclusive to hedge fund managers with access to exotic financial instruments. The ordinary version of this story is less glamorous, but no less real. It is the person who held more cash than felt comfortable in 2006 and 2007, who didn't stretch to buy a second property at the peak, who didn't lever up their investment account because everything was going up, who was sitting on liquidity when assets went on sale in 2009. The single-family home that sold for $800,000 in 2006 and could be purchased for $400,000 in 2011. The S&P 500 at 666 in March 2009, down from over 1,500 in 2007. The corporate bonds of perfectly solvent companies trading at distressed prices because levered funds were being forced to sell. Being liquid at the right moment is not a sophisticated strategy. It is not a complex financial maneuver. It is simply the discipline to not be fully committed when the math stops making sense. And historically, that discipline has been rewarded in ways that take most people decades of ordinary investing to achieve. At this point, I need to tell you something that will complicate everything I have just said. The yield curve is not a calendar. It is not a timer. It does not come with a date attached. It does not tell you precisely when or with what severity or in exactly what form the economic disruption will arrive. It tells you something is structurally wrong. It does not hand you a schedule. And financial markets have a genuinely sadistic habit of punishing both the late and the early. In 2019, the yield curve inverted. Recession forecasters grew louder. The word recession appeared in more news articles than at almost any point in the previous decade. Investors began positioning defensively, and the stock market proceeded to climb for another year. When the recession finally came in early 2020, it lasted 2 months and was caused by a global pandemic that had nothing to do with yield curves or credit cycles. If you had gone to cash in mid-2019 based on the inversion signal, you would have missed a significant market rally. You would have been right about the signal and still lost money relative to staying invested. This is the real and honest tension at the heart of all of this. The signal is accurate, the timing is not surgical, and the gap between those two facts is where most people lose money trying to act on information they intellectually understand but operationally cannot navigate. There is also the argument made by serious economists that the yield curve's predictive power may have diminished in the era of aggressive central bank intervention. When the Federal Reserve is actively suppressing long-term rates through bond purchases, as it did for much of the 2010s, the signal becomes harder to interpret. Is the inversion telling us something about the real economy, or is it telling us something about Fed policy? Sometimes those are the same thing. Sometimes they're not. Anyone who tells you the current uninversion is a guaranteed recession signal is oversimplifying. Anyone who tells you it means nothing is ignoring half a century of data. The truth lives in an uncomfortable middle ground, which is, as usual, exactly where the most important truths tend to live. Zoom out further, and something even more unsettling comes into view. We are not watching an ordinary credit cycle play out. We are watching the unwinding of something that has no real historical precedent.
Between 2008 and 2022, the global financial system operated under conditions that would have been considered extraordinary or even impossible by any economist working in the 20th century. Interest rates near zero or below zero in parts of Europe and Japan for over a decade. Central bank balance sheets that expanded from roughly $1 trillion to nearly $9 trillion in the United States alone. Asset prices that were inflated not primarily by productivity or earnings growth, but by the mechanical effect of cheap money seeking returns. An entire generation of investors, the ones who entered markets after 2010, had never experienced a genuine prolonged credit contraction. Every time the system threatened to correct, central banks intervened. Every dip was bought. Every crisis was flooded with liquidity. The lesson the market learned, repeatedly and consistently, was that risk would be backstopped, that the Fed would catch you. And then 2022 happened, and rates rose faster than at almost any point since the Volcker era. And suddenly, the entire architecture of the last decade, every leveraged buyout, every commercial real estate deal underwritten at 2%, every corporate bond that needs to be refinanced at 6%, every private credit fund sitting on assets that haven't been marked to market since they were acquired, all of it is sitting in a financial system that is fundamentally different from the one it was designed to operate in. The yield curve doesn't create that fragility, it reveals it. It is a mirror that the system holds up to itself. And what that mirror is currently reflecting, for anyone willing to look directly at it, is a system that absorbed an extraordinary rate shock, appeared to survive it, and may still be processing consequences that simply have not fully materialized yet. The commercial real estate market has not resolved. Regional banks sitting on underwater bond portfolios have not resolved. Corporate debt refinancing pressures building through 2025 and 2026 have not resolved. Private equity funds holding assets at 2021 valuations have not resolved. These are not small problems hiding in a corner. They are large, structural imbalances setting in the plumbing of a financial system that spent 14 years optimized for cheap money. The yield curve is telling us that something is fundamentally misaligned between short-term risk and long-term expectations. It has been telling us that for 2 years. And now, as it normalizes, the question is not whether those imbalances exist. The question is what exactly forces them to the surface. Here is where a certain kind of financial content would tell you what to do. Buy gold, go to cash, short the market, load up on treasury bills, prepare for the crash of the century, position for the greatest wealth transfer of our lifetime. I am not going to do that, not because I don't have views, but because telling you what to do is a way of pretending the future is more knowable than it actually is. And the single most dangerous thing in finance is not ignorance, it is false certainty. Confident certainty, the kind of certainty that gets people to take concentrated, leveraged bets on a single outcome they feel sure about. The yield curve is a signal. It is a reliable signal with a remarkable historical track record. It is not a crystal ball. What I will tell you is this. The signal has appeared. It has now moved into its next phase. Every time in modern history that this sequence has played out, the period that followed sorted people into 2 distinct groups: those who understood the mechanism and positioned themselves accordingly, even imperfectly, even with uncertainty, and those who found out what the signal meant while watching the news in the aftermath. The mechanism is not a secret. It has been studied, documented, published, and discussed in public for decades. The Federal Reserve publishes research on it. Universities teach it. Financial journalists write about it, usually 6 months after it matters. The gap between knowing the mechanism exists and actually navigating the uncertainty it creates, that gap is where every real financial decision gets made, by individuals, by pension funds, by central banks, by everyone. And historically, most people fill that gap with optimism, with the comfortable belief that this time will be different, that the old signal has finally been broken by a new paradigm, that the central bank will manage it cleanly, that the soft landing was real and the story is over. Sometimes they are right. But here is the question I cannot resolve for you, and that nobody can resolve for you. If the most reliable recession signal in modern financial history just completed a 2-year inversion that was deeper and longer than almost any in recorded data, and if every major recession in the last 50 years arrived not during the inversion, but after it ended, and if we are currently in the period after it ended, what exactly are you waiting for to pay attention? Not to panic, not to make dramatic moves based on a single indicator, but to actually look, to understand the system you are operating inside, to make decisions with your eyes open rather than closed. The last time this played out, a wave of millionaires was created. The uncomfortable part of that sentence is not the millionaires, it is the wave. Because waves require a collapse for someone to ride.